and welcome to my channel. My name is Ashley, and today we have Miss Nicole Grogan Alston with us. She is a corporate tax strategist born and raised right here in Atlanta, Georgia. She is a mother of 4 and the owner of DNC Accounting Solutions, DNC Business Solutions, and DNC Academy of Entrepreneurship. And today we are going to be discussing how taxes relate to probate and estate planning. Now let's get into this. Okay, Nicole, are there any potential tax consequences to heirs based on the asset that they inherit?
Yes, and it really depends on the type of asset that they inherit. Okay. Like property, again, we go back to talk about real estate because a lot of times that's what a lot of people inherit is real estate. When they inherit money, no, they're not going to pay any taxes on the money because typically the money has already been taxed. So the taxes have already been paid on that. However, if it's real estate property and they are in a position to where they're receiving this property, but they don't want to keep the property and they want to sell the property. If they want to sell the property and they sell the property for a gain, which means they sell it for more than what it's actually worth, they're going to be responsible for what's called capital gain tax. And typically that ranges from 20% all the way up to 40%. It just really depends on how much that gain is. Another type, when it comes to, a lot of people have questions about life insurance policies. Typically, life insurance policies or proceeds are not taxable. However, if it's a policy that is gaining interest, the interest on that life insurance policy is taxable. Okay. Take, for instance, retirement accounts. If they receive retirement accounts, 401k, we all know distributions are taxable, but we do know that IRAs are not taxable. However, again, if it's any type of interest that has been placed onto that retirement account, that piece is what's going to be the piece that's going to be taxable. Okay. So we always have to make sure that if it has not gained anything, there's no taxes on it. But it has gained something, it's going to be taxes on it. So we have to make sure that depending on the type of asset that we receive as an inheritance, whether or not it has any type of additional income attached to it.
Okay. Are there any time guidelines associated with, if you, for instance, the capital gains? Is there a certain time frame, if you don't sell it within this time frame, then you can eliminate the tax, or is it?
It's just deferred. It's just deferred until you actually sell it. There's no time frame for you to actually sell the property. Okay. And sometimes, again, if it's just a property that you are inheriting from your family or a family member and it's not making any income, you're not going to pay any taxes on it. You're only going to pay taxes if you sell it, remember, above what that value is at the time of the sale. Besides that, you can pretty much not incur any type of taxes if you don't have any of those type of gains. I mean, capital gains, if you don't have any interest attached to the retirement accounts, any interest attached to your life insurance policies, things of that nature, then you can kind of avoid that tax.
Okay. All right. Well, thank you for sharing that with us.
Subscribe to my channel to learn more about probate real estate, financial literacy, and generational wealth planning.